All right. Thank you so much, everyone, for sticking around. I've said all I've had to say, and I've introduced everyone that is going to join the second panel as well. So we'll start off with Lila giving us another more in-depth review of Chapter 4 of the report. And then after that, we'll invite the panelists up to the stage to come talk through it. Thanks.
So thank you again for being here today and for organizing this event. So as Fouché mentioned, this second session will rather cover the fourth chapter. So where we discuss reaching energy security as a key foundation for growth. So why did we decide to focus on electricity? For two obvious reasons. The first one is its impact on growth. Load shedding has imposed a strong cut on economic growth, as you can see in this estimate from the SARB in 2023, but also later on, the cut has been significant. This is because this forces firms to adopt less efficient technology. This is one thing, a direct effect, but also this reduced business confidence. Firms have less incentive to invest because basically investment most often rely on electricity availability, and SMEs are have less incentive to enter the market because they are more sensitive to such shock. So the second reason for which we focus on electricity relates to the green transition. As Luis mentioned in his presentation, the GDP is highly emission intensive in South Africa. But interestingly, when you look at the sectoral composition of emission, you can see that almost half of these emissions come from energy and electricity sector. So this means that if you manage to cut emission there, this can make a big difference in terms of green transition. So some efforts have been achieved, have been done, and some progress have been achieved recently. You can see in this figure that the share of renewables has doubled between 2017 and 2023. You can see also that the rooftop solar panel contribution to energy mix has increased quite significantly. However, this is not enough to reach the emission target and the green transition. You can see here that South Africa is significantly lagging behind in terms of the share of renewable energy in total energy supply. So in that chapter, what we did basically is to try to see the energy security issue and the green transition issue as two faces of the same piece. So, and to look at reforms and measures that could help to achieve both of them at the same time. So the first building block of our analysis, we discussed that before, relates to the regulatory framework. So here again, I report our famous product market regulation indicator, but here I focus only on electricity, the sub-indicator for the electricity sector. And as you can see here, South Africa, in the right, appear like one of the most strict regime in terms of business regulation, and it is less competition friendly than other countries. Why is it the case? What drives this indicator high? A first reason is the barrier to entry in the electricity sector. Entry in the electricity sector is basically limited to the independent power auction program, which means that these independent producers do not directly compete with ESCOM, and this reduced incentive for efficiency, this reduced incentive for lowering prices. So that's the first issue. The second main reason for which the overall electricity indicator is high relates to the lack of competition in retail trade. Here again, international experience suggests that competition in the retail trade segment improve the services to the end user and tend to lower prices. So we think these are two directions to consider for reforms. So in terms of recommendation, we make two types of reforms, a bit phasing our recommendation. We suggest in the short term, because it can take time for regulatory reforms to be implemented, to first strengthen independent power producers, to increase and to maximize what we can get from them in terms of supply of renewable. So this involves, for instance, streamlining criteria selection. In the medium term, the main objective is to establish a competitive market, as I mentioned before. An important step has been taken with the ERA Act recently. And so our main recommendation is really to fast progress in this area, like establishing the wholesale market, moving toward the full independence of the national transmission company, and establishing competition in retail. The second building block of our analysis relates to transmission and the huge needs of investment in the transmission network, which will require some complementarity policy in terms of finance and the barriers to finance. Let me explain. So the transmission, the project of ESCOM in terms of new transmission line is quite ambitious, 14,000 additional kilometers. This was mentioned also by Louise before. This means really ramping up significantly the investment effort. So far, there has been at least 500 kilometers built per year, and we need 2,000 kilometers additional per year. So how to accelerate, how to finance that? When we look at the just energy transition, we can see that the electricity sector, to be transformed, requires almost $50 billion. And most of it, majority, will be needed for the transmission. And in the right, you can see that only $4 billion has been fully secured so far. So there is a large investment gap. And this investment gap requires attracting significantly private investors. The problem when attracting private investors in transmission is that it is an area much more difficult to finance than generation. And this is really related to the characteristic of this type of investment. It is a long-term investment, so it takes a long time to pay off. There might be over this period some uncertainty in the demand for electricity. There is a need for large upfront cost, which also increase the financial risk. Administrative burden or change in policy direction also add to the financial risk. So all that contribute and will contribute to create some barriers for private investors. So in the survey, we discuss how to ease these barriers, and this include reducing the change in demand risk by really moving fast in this new program of independent power transmission, easing the financial risk by exploring new de-risking tools like credit guarantee vehicles or escrow account, reducing regulatory risk by fast-tracking procurement, doing even better in easing administrative burden, and to reduce the change in policy risk, really establishing time-consistent, clear and transparent policy, in particular in environment. The third building block of our analysis relates to the price-setting framework. So an effective price-setting framework is necessary for the market to work well, and tariffs have actually usually several objectives, and some of them are contradictory. So ensuring the cost recovery for the generator, ensuring a cost recovery for the distributor in charge of the distribution network, providing price signal for the green transition, and keeping electricity affordable. Let me just give you two illustrations of the challenges in South Africa. So first, it relates to the well-known problem of increase in price in tariffs. So as you can see in the left, electricity tariffs have increased much more than inflation over the last decade. And in the right, you can see that South Africa, which used to be the country with the cheapest electricity in the world, has now taken over several emerging countries and even the OECD average recently. So this means that affordability issues are starting to be raised, and at the same time, we haven't resolved the cost recovery problem. So there is a big challenge here, not easy to be fixed, but which is worth to mention. The second main challenge relates to the green transition. Here you can see the net effective carbon prices, which are relatively low compared to the OECD. In the right, we have also reported an approximation of the net subsidies to ESCOM. And you can see that when you consider the fiscal transfer in blue, the electricity levy in brown, and potentially the carbon tax, to which they are exempted, so it does not appear here, the net subsidies to Eskom remain very large. This means that the price signal is not strong enough to move out of coal. So in the survey, we make several recommendations. The first one is to continue progressing toward cost-reflective tariffs, however, under the condition that some efficiency improvements are made. And what is important to ensure is that unnecessary costs are not passed on end user. And this could be achieved through several, or at least progress could be done through several tools, including being more transparent on the cost of each segment or boosting efficiency incentives. The second main recommendation is to increase price signal for transitioning out of coal significantly. This means basically reducing allowances, which are very large, cutting very largely the tax of companies. And finally, to provide some incentive for supporting the decentralized supply of electricity by incentivizing net selling or supporting municipalities in that transition. The last building block of our analysis relates to actually building capacity, municipality capacities. So, as it is well known, debt of municipality has grown over years, so many of them are over-indebted. And in the meantime, the arrears payment to Eskom has increased. So this contributes to the chain of debt, to the financial instability of the sector. Municipalities lack capacity to meet their task in several levels. First, in infrastructure oversight. They have difficulties to invest in maintenance, in expansion, in new systems. They have difficulty for basic management, like in bill collection, in distributing free basic electricity. They have difficulties as a contractor, especially to contract with IPP, while this could be really a super powerful tool for the transition. So here we suggest and recommend in the report to increase financing capacity. This may involve revising the municipal funding model and increasing property tax collection. This involves also earmarking electricity revenues to avoid cross-subsidization. This also involves, and maybe we can discuss that, concessions for distribution for municipalities that are struggling the most, and also building some managerial capacity. This can start by pooling municipality in order to increase the skills there, and also to build progressively for the medium-long term managerial capacity and having the right type of staff. So in this last slide, I summarize the different economic failure that has been identified in the survey. Corruption, which is something that I touched before, regulation, so price setting, capacity building, and barriers to finance. And we believe that addressing these challenges will increase as the potential to increase electricity supply, and in particular, supply of renewables, and to move toward more energy security and the green transition for a stronger foundation for growth. Thank you very much. I'm finishing here.
Thanks once again to the OECD for a report that is very comprehensive and not a little bit scary. So same rules apply. If you do want to quote anybody for any publication, please just check it first with any of the panelists. I want to say that this is an area that isn't mine. I'm not overly familiar with the ins and outs of energy policy and its challenges. I do want to start off with like my only really successful public finance joke ever, which is that you can't spell sunk cost fallacy without SAA. and I wonder whether that is part of our story in the energy sector. But I thought maybe I'd start off by just allowing each panelist to talk about what is the single most important thing that we have to get right? There is a very large value chain that has to improve across across the energy policy spectrum. But what's the single most important variable in getting this right? I'm not sure. I don't have any strong views on who wants to go first, but maybe I'll just go from Trudi down.
Let me just grab a mic. I hope this is working. You can hear me fine. Michael Sachs at the back. Okay. So if we think, I mean, you asked about one single variable, which is a really difficult thing to do, right? Because as you said, it's a complex value chain, and the OECD report really points to about 20 years of policy a policy evolution that has been very difficult over that 20-year period, and also an electricity system that clearly was under severe pressure and in some ways failing to deliver what it needs to do over that period. And it's compounded by so many reasons that are presented. So it's very hard to drill it down to a single story. But I think given where we are in terms of that evolution, where and I walked a bit of this journey with some of the people in the room, where we got to a point where the government released or eased regulations in a way that got renewable energy restarted and new capacity coming on board. And so the question becomes, what is the next constraint? And the next constraint clearly is around the grid infrastructure. And so if one had to choose an important thing for this moment to get us to the next step, I would say that investment in infrastructure, in transmission infrastructure in particular, is an important step. And we've seen a flurry of activity around the work at Eskom in terms of restructuring the organization, creating a level playing field, ensuring that you set up the conditions for a market to emerge. So then the question becomes, are we setting the market in the right way to attract, to maximize on the investment that we're able to get? Because we also have seen the fiscal constraints. That investment is going to come from a wide range of sources. So, if you look at the JETP, which was also mentioned now, the investment plan, transmission investment, a very big part of that. We have a bit of a cost of capital story also bubbling behind that in terms of understanding how, from even our macroeconomic perspective, we reduce the cost of capital in South Africa in a way that ensures that to the extent that we take on some debt, it's not punitive. But I think the bigger story is around enabling a wide range of players to come and invest into the transmission network. This is a kind of a bit of classic opening up of markets, which often gets confused with privatization, which is not, because I think in any market, you still need a pretty important role for a planner, for an orchestrator, and that will always, mostly be the state, but also ensuring that you get other players to contribute to that. So, yeah, I'd have to pick.
That's your one thing.
That's my one thing. It is one thing. Opening up the taps to have the flow of investment into transmission.
I have two things. Because as Trudy's just shown you, it's impossible to say there's only one thing. There's two things that are important. I think the two things are prices and regulations. So if we're under those headings at the current moment. But I think the other word you can't spell without sunk cost fallacy is PBMR. So the two things are prices and regulations. So there's been huge contestation and continues to be contestation around the technologies that we will use to generate electricity in South Africa. And I think it would be important to ensure that the planning tool continues to deliver the lowest cost outcomes, so to bring down the electricity prices. There are significant risks. We went through the era of building Russian nuclear power stations, and that was then planned out. We went through the era of the gas power ships, And then that was ruled out. We're going through continually, there's pressure on this planning process that tries to move it away from the lowest cost option. And it's really a challenge. The current challenge that we saw from the slides presented by the OECD, that South Africa's electric prices were the lowest in the world. And that was the problem, actually, because prices were not enough to ensure that future power stations were built. They were kept too low for too long. There was a misalignment. But now they've been rising. If we want to have an internationally competitive economy with growth, we must have that objective of low-cost electricity being restored for this country. And we mustn't allow the planning instrument, which is essentially the IRP, to be deviated from that. And I won't go into it now, but there are huge pressures to move it away from that in a very untransparent way at this very moment. There are huge pressures again. The second word is regulation. As Trudi reflected on, there was a big bang in South Africa's electricity sector. We've totally deregulated in the sense that you no longer need to get a license in order to generate electricity. Previously, it was illegal. Only a DESCOM could generate electricity. So we deregulated. Now that we've deregulated that, the market is changing extremely rapidly. The market is so the IRP planning tool was the only planning tool. It's no longer really the only planning tool because electricity generation is happening at a private to private level. That's why the grid is important. That's why wheeling policy is important. So in a nutshell, we need to learn how to regulate for this. Not only is there an energy transition, but the structure of the energy market is transitioning from one which was a natural monopoly with good economic reasons for being one to one which is now competitive. How do you ensure that the wheelers do not free ride on the grid? That they don't pay? How do you make sure that they don't pay too much? And therefore they don't invest. Very important that we get that regulation right. So that's my start. Those are two things.
Also not one thing. Ansuya?
I think there's three things. No.
Three different things.
Yeah. Yeah. Well, I mean, our long-term planning documents look at an energy sector that's reliable, affordable, and decarbonized, right? And that's the energy trilemma that many countries are struggling with. But I think what isn't articulated so clearly is those trade-offs that happen between those different objectives. And specifically, I mean, in the first panel, there was also a conversation about sequencing, that's time-bound as well. So I guess the one thing for me would probably be about an overarching market design to say, how do we get from where we are now to where we're going? Because generally when people are talking about those objectives, they'll focus on one thing. And sometimes those activities don't talk to one another. So there's still silos so there's a lot happening on the ground, but how does it all connect up? If you look at how generation is actually sort of coming online, right? We operate in a de facto market now. It's not centralized, it's not optimized, but it's still pretty deregulated, actually. In theory, we will have a wholesale market. We have bilaterals that are kind of regulated by contract. We still have the government procurement through the REAP programs. And Eskom has just started a new renewables arm to its company. So how does that all fit together? And I think that's creating some regulatory and policy uncertainty, which these investments take a long time. So addressing that, I think, is particularly important. And in some cases, the market that we're trying to introduce is almost trying to solve for prerequisites that should be in place prior to the introduction of a market. So things like capacity shortfall relative to demand, or pricing being unbundled, cost reflective and clear, an independent grid operator, grid access. All of those things are part of a broader market design. And I think one of the things that was highlighted in the report as well is what happens with municipalities that aren't paying. How does that fit into the market? So I think there's a lot of uncertainty still at play, and it's a very transient situation. But overarchingly, if we can say, how do these long-term objectives fit in with what's happening now, that would do a lot to clarify where we're going and that direction of travel.
So I can... What's that? I can find out one. Thank you. Well, I can say ditto, right? That you summarized all the items so well. I think for me, the one thing that needs to change is a change of mindset for the electricity sector. And we've been discussing through lunch as well. The ESCOM we knew is not going to be the ESCOM of the next 10 years. And the electricity sector in South Africa that we knew in 2008 is not the same that we're experiencing now, and that the needs of the country are changing. The economic structures are changing, but also the global environments are changing. So the change of mindset comes from trying to find the synergies between the policies that we're discussing now, no matter if they are policies for the mining sector or for energy efficiency, the demand side management, that sometimes we tend to forget. We focus on the transition, and how the supply and the generation, but we tend to forget the demand side sometimes. So get the policies right, that they speak to each other and they don't put hurdles to each other. I think that needs a big holistic view of where we're going. So I come originally from Greece, and there's a saying there that I was saying to Ansuya earlier, if you have a few eggs in front of you, you can either make an omelette or you can see birds flying. In South Africa, we try to do the omelette and the birds flying and the big chickens and the this and the that. And somewhere this system needs to be much better coordinated. So how do we get it coordinated? And I think that will be my one thing. Skills development. You need, back to my metaphor, you need the person that will be able to take these eggs, or the teams that will take these eggs and say, these eggs are going for omelette and these eggs are going for birds. How do we do that? We need to look at what is happening, what skills we will need, and not what skills we need now. I think if we start developing programs with the mindset of what skills we need now, we are going to be always a step behind. We need the skills of the future to start being developed now. And by that, I mean the skills of the people that are already in the labor market, the skills of the people that are going to lose their jobs in these transitions. And we will see that happening. We've seen that in the graphs and the report. And it was some of them in chapter 2, which shows the interlinkages of the economy. We need the skills of the people that will lose their jobs, and what are we going to do with them? And we also need the skills of the kids that are at school today, because they will be in the labor market in 20 years' time, when the IRP is going to be at the end of where we're supposed to be. And there's going to be another 30 IRPs until then, I'm sure about it. But we need to have the people that will take over then at least not make the same mistakes that we are making or we have made until now.
Mila, do you want to come in? Do you want to...
Just to react and to answer your question. I mean, we exactly had this holistic view to try to really find where are all the bottlenecks. And I would say that on my side, the most important things to be done in the short term is really market structure and transmission. These are the two main challenges in order to advance quickly on energy security. And this requires implementing. I mean, in South Africa, something that I have discovered when working on South Africa is that it takes a long time, sometimes, between law, which seems very well designed and we are often really aligned, and the implementation. So here, I think for even the ERA Act, we need to progress fast. And lastly, you have touched on this, but I would be very also glad to hear about from the panel about municipalities. I mean, to us, it's really the big struggling point now and very, very difficult to resolve. So we make some suggestions, including concessions. So, just want to put this also on the table. Thank you very much.
This is an area that I'm loath to touch, but Kenneth raised this question of the contestation over the energy mix and what the IRP should look like. I wanted to say, just in relation to the report, so in chapter 1, there's this very interesting graph about the degree to which South Africa is unusual in that it's got so few protections against lobbyists in the regulatory structure. I thought the same point might have been made in chapter 4, where it seems to me like that is a real issue. And the just energy transition is often framed, I think, in relation to coal miners, actually the employees of coal mining firms. But it seems to me like, I mean, I've been involved in conversations where the just energy transition, the constraints that are envisaged on what is legitimate in the transition are so severe that you can't imagine how a transition could happen. So almost nobody can be worse off than they currently are in the industry, and that seems to me like a profoundly misconceived idea of how a country can resolve an energy crisis. So I thought maybe just your comments on that. Like, do we need to be harder on the coal companies, the coal mining companies? Are they an obstacle to this, to the transition? Anyone who's brave enough. and I mean, it's obviously they also have a value chain. It's the truckers and the coal miners, and it's quite an industry.
Yeah, I'm happy to come in on that. I mean, I think the just energy transition in some spaces is kind of mischaracterized in South Africa, because sometimes it's spoken about as though it was pushed on South Africa by external powers based on funding from the JEP, right? The reality is that the coal-fired power stations are old. They are reaching their economic end of life in terms of our planning. So the decision is whether you invest in massively revamping these power stations, you invest in new coal-fired power stations, or you look at other capacity. So I think that's one of the important starting points, right? Yeah, and when it comes to sort of that just energy transition, if we look at coal mining closures, for example, there were supposedly like very good policies on that closure to protect communities. But in reality, what that meant is that mining companies would sell those assets off to smaller and smaller companies and then bankrupt the last companies, or that they would have skeleton crews. So I think it's again this issue of implementation in a lot of circumstances, that the policies are trying to address these issues, but the reality on the ground is very far from what is envisaged. And I think we also just need to be more honest about the just energy transition, because I see a lot of people saying no jobs will be lost. And like the jobs will change because that's the nature of transition, right? It's a commitment to ensuring people are still kept within that change. So in that respect, I think it's important. But overall, I'd say there's a duality to South Africa's just transition, because as you correctly say, I mean, there's a lot that has to happen. Their risks are high, but there's also the situations that we don't have stranded assets in the same way that other countries do, at least to the same degree in terms of coal-fired power stations. So that's actually an advantage when you're looking at a transition. And so I think it needs to be looked at overall in terms of both sides of the same coin, basically.
Anyone else want to come in on this? Kenneth?
Can I? Okay. Okay, two points. The one is, I've been saying recently, we shouldn't speak about the energy transition. We've been transitioning from energy fuel to energy fuels for millions of years. It's not a unique, and we've been transitioning from technology to technology for millions of years. I mean, go back, I say usually to students, go back to the before fire and after fire. We're talking about energy transitions. It's not a unique phenomenon. It's not a unique event now. We are transitioning. And in all transitions, whether energy or technological transitions, there is resistance. The first typewriters had a problem when the computers were introduced. They lost jobs. In the long term, they were absorbed somehow. So in all of this, we talk about fourth industrial revolution and the AI era, and our jobs will be lost and all of these things. In the long term, somehow the society, the economy, the energy usage, if you may, transitions. Now, what makes it difficult is that we're sitting here and we're talking about the now with the people losing a job today, and not about philosophically and theoretically, it's fine if I lose my job today. Next year, my kids will have a job. It's the now that we need to deal with. The second thing about the energy, the just energy transition, I promise you, at some point, I want to take a photo of a jet, because if I see jet again, a jet, and put in my office and say that's a jet, let's discuss about transition now. Is the coal mines need to plan not only based on the coal demand within the country, but also based on the global coal demand. And what we have discovered, we do some modeling recently on these scenarios, is that affects the speed of the transition. Nowadays, nobody argues that there is a transition. The question is how fast, how slow. So if we decide in South Africa to decommission our coal generation power plants in a faster pace, but the rest of the world still demands coal from the coal mines, there is a period that will be almost like a buffer for the coal mines. And therefore, the jobs will be decreased in a much smoother way than closing the coal mines from one day to another. So we need to also think that we're not South Africa, no country currently, as far as I know, you can correct me if you want, lives in isolation in this energy transition. We all have to look at the global dynamics when we look at our local dynamics.
Thank you. Just indeed a few words on your question. Should we be tough on coal? I mean, yes, for the transition, there will be a need, of course, to increase and to be tough through a higher carbon tax. That's the first important policy tool to implement. We really push for that. But at the same time, I mean, the transition, as you said, will be long. I mean, we still need a reliable source of energy, which means that coal has still a role to play for the decades to come. So, but the energy mix needs to be changed progressively, and this comes from right price signal, but also more competition that we mentioned, but also within Eskom, there will be a way to provide some incentive for Eskom. You know, if you create a subsidiary of Eskom producing renewables, you know, this compete directly with Eskom, and there is also an interest. I mean, these sort of things have been done, for instance, in France. And the last thing about the demand of coal on coal from abroad, indeed, I mean, this modify directly we demand the transition, but I mean, I think South Africa need a bit more maybe of a political economic communication on why it is good to transition. What are the health issues related to coal? That's really important. The risks are here. What are also the economic issues going forward with the CBAM in Europe and the loss of competitiveness? So these kind of things are very important to communicate in order to have some political support. Thank you.
Yeah. There a lot has been covered on this working on this coal issue. It's really not constructive, right, to pit it as coal versus litigation. I mean, you do see some coal companies trying to think creative about how to invest in energy. You know, we have those examples even in South Africa. And I think we've lost the narrative. I agree to in the point where the JEDP was presented as something external, even though a lot, you know, the country was quite clear that the principle that we're getting at here is embedded in the Paris Agreement, embedded in kind of the global climate. The principles behind the JEDP are the kind of fundamental to climate transition, being that rich countries who have resources will support the transition in developing countries. And so, you know, the international partners came together. So it's a principle that developing countries themselves had fought for. It's not something that comes from rich countries and saying you must get out. It's actually us holding us to their international obligations. But I think we lost that part of the narrative. But I think going forward, we do have to be honest about the trade-offs that we're seeing. I think what will always be a difficulty in our political economy is that we are a high emissions but also high poverty economy. in a way that it's very difficult for us to draw international examples. All the countries that have mostly successfully transitioned were high emissions but high income. And so we always have to understand that pushback will always come to say, we did have an industrial policy based on cheap electricity. That was our thing. And in a high unemployment economy, to move away from that is going to be a far more complicated endeavor than many, even our emerging market peers. But I think just if we keep reiterating the message that factually, this is the least cost path to go on, and factually, this came from us. It's not the other way around. We will keep making perhaps not as fast progress as we should do, but at least it will be realistic.
Yeah, just to add a little bit to that, I think everything is hard to do in South Africa because of the high poverty and exclusion, including the just energy transition, because it makes it harder to do. I think the only point I want to make is that we should define the just energy transition as widely as possible, not too narrowly. So it's justice for who? Who is this justice for? And it has to be justice for as many people as possible through ensuring that we get the economy competitive. We've got reliable, low-cost electricity. We've got low-carbon electricity. We can export. We can participate in the global economy. Then you're talking about a wide conception of justice. You can't just say it's justice for those who have a job now. Those people will have to be assisted with pathways, definitely. But we can't say we must stop the transition because what might happen to them.
So I want to come to something Trudi raised right at the beginning, which is the cost of capital. The numbers, I'm sorry, I'm not sure I've gotten them completely right in my head, but whatever they are, they're absolutely staggering, right? The costs of what needs to be done, the 14,000 kilometers of transmission lines, plus all the investment that has to happen in generation capacity and in local networks and all the rest. These are investments that are huge upfront costs before any cash flow starts, before there's ever any positive cash flow at all. And the numbers are staggering. So how do we manage that, the mobilization of those resources, and not, also bearing in mind the conversation of 2 hours ago of the challenges we've already got on the debt front and the contingent liabilities are not negligible either here for government. You don't all have to jump in, but Trudi, I would like to hear what your thoughts are on how we do this and what this means macroeconomically and for our capacity as an economy to service the debts we will necessarily have to raise for this.
Yeah, I mean. Is this the one that works? Okay. The global context is not easy in that, there's analysis that was issued by IFC and World Bank based on their own portfolio experience, which showed that generally African countries, all of us, from north to south, tend to pay far higher for our debt, even at equivalent credit ratings. So we could all be BB minus, but BB minus in Europe will pay far lower than here. Also analysis that shows even for deploying renewable energy technologies, we would be paying at least 6 basis points more than equivalent projects in other parts of the world. So we're already starting on the back foot from that perspective. I think then with South Africa's fiscal indicators also creating an additional perception of risk, then you add to that layer. So we do have to minimize the risk premium to begin with. So some of the instruments we could think of is how this is a bit of a trivial one, how much we can get in terms of grant financing, concessional, actually just pure grant financing, to get feasibilities going, to kind of do preparatory work. And then the next stack would be around concessional capital, which is partly what, the Just Energy Transition Investment Plan tries to attract, where we can make the case that there is a decarbonization benefit to this, there's a social benefit to this, and therefore longer term, more patient, more concessional capital can come in. Not very easy, because we've seen in terms of the commitments already that have been made versus the drawdown of the flow of funds, that is slow, and there's a gap. But we've got to get that concessional piece right. And then once we get from that, then there are lots of projects that will make sense commercially once the market reform makes sense. And so we have a much bigger stack of financing that will have to come from that, and the returns and the risk is kind of all absorbed by those private players. So I think it's just working through that capital stack, as many other developing countries have to get the right kinds of investment for the right kinds of things. Because I think in the past, we also kind of run to government debt for things that perhaps appropriately should actually just be on private commercial balance sheets and be taken, handled in that way. So it is a conundrum. As a reality, we will pay more than other people, but there are things that we can do to at least make sure that we engage even our domestic private sector, our domestic pension funds appropriately, not forcing them, but appropriately to fill those gaps.
Does anyone else want to weigh in?
A bit tongue-in-cheek, but maybe our lack of financial capacity will be our saving grace in this regard, because I think if we had tremendous financial capacity, we might run off and build some white elephant projects that are not going to take forward this vision of the transition. There's debates around whether there should be infrastructure built around gas, there should be guarantees, nuclear build. There's many things that are just not financially viable on the sovereign. And therefore, as Trudi says, more and more of this, it's not so much the transmission, which will remain as a natural monopoly, state-owned, but more and more of that competitive generation market won't need to come near the balance sheet of the state.
It still will have to be paid for, right? So that's the consumers will have to pay for those high charges. I'm going to open to the floor, but before we open to the floor, this has been maybe a somewhat down session. I should have had dessert. But I want to open the possibility of a more hopeful picture. So the OECD report paints, and correctly so, obviously, that electricity constraints have been a constraint on growth, and how we have to resolve that if we want to get back to our old potential growth rates. Is there a story in which the energy transition can raise our potential growth rate, not just fill the gap in what that we've created by having 15 years of an energy crisis, but is there a story in which we actually turn this transition into something that raises potential growth, not just returns us to the moderate levels of potential growth that we used to have? I'm seeing some very enthusiastic nodding, so I'm going to go with Roula to start.
It's the discussion we have many times with especially CGE modelers. There is no intervention, no policy that creates only losers. All interventions, all policies creates winners and losers. All situations, all changes create positives and negatives. And sometimes our nature is to look at the negatives so that we have a problem to solve, and we forget to look at the positives. And I'll give you a positive just now. But we forget to look at the positives and accelerate them and accentuate them and use them to our advantage. So the moment I say the word load shedding to South African audiences, the reaction is, no, not again. I don't want that again. Now, go and the next time you're next to a person that is in an SME in the solar space, Tell them load shedding and see how their body language changes from us doing this to them doing, yes, when is it coming again? Because with every wave of load shedding, the solar businesses are roaring. The solar installations, you see these trucks going right and left. And it's the same with water. I mean, we sometimes forget the water in all of this. But the other day we had in Pretoria East 5 days without water. The amount of jojos on bakkies that were transferred in houses were immense. So I think every challenge is an opportunity. And yes, that was a very specific example on load shedding, but there are studies now that are looking on whether these problems with, first of all, electricity prices going up, and second, unreliable electricity supply, whether that have accelerated the adoption of solars at the household and business level. Whether it has accelerated the self-generation and whether it has accelerated us looking at the conditions of changing market structures. So maybe that's where we should turn a little bit this discussion of the energy transition and this just energy transition. What are the positives? I liked the comment earlier about the awareness and transparency. We speak about carbon tax. There is a theoretical hypothesis. You can look for it. It's called the Porter hypothesis. So that hypothesis states that with more stringent environmental regulations, so higher levels of carbon tax, we have higher levels of competitiveness and innovation because the businesses now want to reduce their costs, so they look at more innovative ways to go around that. And South African manufacturing sector is famous for innovation at difficult times. So maybe we should look into this innovation and how we can boost innovation into all of that will create also growth, but also find solutions to get out of the energy crisis. Maybe I'm the one in the pink cloud, but I think there is a good future coming away.
Thank you. I just want to react to just what you said, because we have done some paper a few years ago at the OECD, which really illustrates your point. During the energy crisis, we were wondering whether an increase in energy price, what is the impact on productivity? And really what we found is that first you have a shock on productivity. This is certain, this is unavoidable. But afterward, firms are starting to invest, and sometimes to invest also in more efficient technology. So you can see after 3-4 years an increase in productivity. So this means that the move toward renewable, an increase in carbon tax can be also an opportunity in that regard. And this effect is even stronger when you have strong policy, environmental policy, consistent in time of policies, and all that really can help to grab these opportunities. And last point on these opportunities, South Africa is really well placed theoretically to have a great comparative advantage in producing clean energy. And in a world where carbon is increasingly taxed, this might be a good move for the near future to accelerate that. Thank you.
I can't resist when somebody says comparative advantage. It's such a lovely idea, that, because this is, if you know the history of South Africa, we had a comparative advantage in being able to use abundant coal resources in order to beneficiate, make steel, do industry. And that was the growth model of the apartheid regime, its industrial growth model, combined with land expropriation and apartheid policies. But that was its industrial magic. And I do think that because we have a comparative advantage in coal, doesn't mean we don't have a comparative advantage in other sources of energy as well. And it's well proven, if you read the wind atlases and you read the solar atlases, that we have a comparative advantage in the production of renewable energy. We can produce it more cheaply. It's Australia. It's like Chile. It's a certain latitude that has this advantage. And we can then build upstream and downstream industry like the apartheid model where you say we've got cheap electricity, now we can do green hydrogen, now we can do green steel, now we can export, we can rebuild those sectors, the upstream and downstream, from a competitive cost base.
So that is a more optimistic take, and so I'm not going to say anything more. Are there questions from the audience? Konstantin? And then, sorry, I can only see a hand. I can't see a face. I don't know. It's Alia. It's Alia.
Thanks, Anthony, and thanks to the panelists. I have two questions. The first question is, if you look at other countries, South Africa's energy electricity reforms are 20, 30 years old, kind of compared to other countries, right? So other countries did what South Africa is doing 30 years ago, 20 years ago. If you look at the OECD Economic Survey reviews, over the past 20 years, you'd find this kind of continuous recommendations around the electricity sector. So my first question to the panel is, why did it take South Africa 20 years to realize that we need to take a model that other countries have been kind of implementing for the past 30 years? My second question to the panel is, Kenneth spoke about how electricity deregulation has had this massive impact on renewable energy. And this is a very good example how a climate change objective is influenced by a policy area which falls outside climate policy. And effectively how broader micro policies can impact climate change or various other things. So I'm wondering, what do you think are the broader policy obstacles that hinder the electricity transition?
Take Adia's question and
Thanks to the panel. This has been interesting so far. So I like the idea of defining the transition, and I was wondering, I think, it's sort of in the messaging, we talk about a pathway to lower prices, but it doesn't come out explicitly. And I don't mean necessarily lower nominal prices, but lower nominal increases. If you stop getting these 12 or 15% increases to a more predictable price path where it's sort of 2 to 3%. And I suppose we've spoken about competition in generation and increasing efficiencies, and that's the pathway to bring down prices. But I was wondering if the panel could reflect on whether the market structure envisioned in the era goes far enough in terms of taking us to the pathway towards lower prices. And I also, another way to define the transition is also in terms of opportunities. And we've done this, there's a South African Renewable Energy Master Plan, but, we can also talk about the steel intensity of the transition, which we sort of haven't really, I'm not aware that we've discussed this enough or spoken to the opportunities enough. Thanks.
So policy questions, people. It's no time for no rest for the wicked.
Yeah, I've got the mic.
You got the mic.
Well, so why did it take 30 years? I think just the politics didn't work, right? Because the Energy White Paper in 98 had all of the seeds or referenced global developments and envisaged the market structure that prevails in terms of vertical unbundling, etc. Like none of these ideas are new. They were all in that paper 30 years ago. So it's not that people didn't think about it. I think we've got to look for an explanation in the political economy. Similarly, if you look at telecommunications reform, that path was quite different, driven by a value-added industry coming up and really challenging the monopoly of telecom, and not just challenging it, but literally instituting legal competition cases at the Competition Commission and forcing rulings from the competition authorities that called for, vertical separation, all of the things we're talking about. So that was a different path of getting to the same outcome. I guess in this industry, in energy, it probably won't play out that way because you don't have that value. You don't have an empowered value-added sector that's banging at the doors. They actually have to contract with the state. So they're not likely to take a litigious route. But there are many paths to reform and that are very well understood in South Africa. I'm not qualified to talk about the politics, so I'm just going to leave it there. I think on the steel intensity, your question triggers something on the opportunity side, but it's a difficult opportunity to realize because there's this question around industrial policy. And the greater imperatives of energy security. So the theory, people like Ricardo Hausmann have been arguing that developing countries should think about not only their own decarbonization, but how to develop industries along that decarbonization path. So a green industrialization play. Once again, very complicated because then if we look at our experience over the past 10 years, we wanted to have wind turbines manufactured in South Africa. We wanted to have panels. That ship has sailed. What's the next thing that makes sense from a local competitive advantage? So I think you mentioned steel intensity, probably not steel, but there are opportunities that I think we should think about, but it requires a bit of a real heart-to-heart, I think, between kind of macroeconomic policy and industrial policy.
I just briefly, earlier's question, I think, on whether the regulations will achieve lower pricing and whether they're up to scratch. I think it's a good question. I noticed in the OECD report, I was sitting at the back, I couldn't quite see, but it looked like we were ranked the worst in the whole report with regard to the degree of competitiveness. And I thought, well, yeah, that's not good. But I don't think it's up to date, that report, because things are happening so quickly that I don't know if the market is almost moving more quickly than the regulations. So if you're going to judge how we are on the regulations might not have caught up with the market. It's a complex thing. For example, I don't know if you saw Discovery Bank is now selling electricity. So now, how is a bank selling electricity? Well, what it's doing is done a deal with Sasol. Sasol's got, in the Eastern Cape, has got excess. They're using their wind turbines for themselves. They've got extra electricity. They sell it to Discovery. It's so much cheaper, that electricity made by the wind farm, that you can then buy it in Ekurhuleni. It's virtual wheeling. This product exists. It's already available. People are buying it. Prices are coming down because you can buy cheaper electricity using these tools and these instruments. The regulator is not there. We're just not catching up with that. So I think we're doing better than you think we are. If you could rescore it, maybe. But to be honest, it's a difficult question because things are happening so fast and we are stodgy, we are slow, there are political economy issues. But things are moving in that sense.
Yep. So to the first question about, why has it taken us 30 years or 20 years? This is not try number 1, right? This is try number 3. And I think a big part of it was that prices were cheaper. And that was the industrial model. So if you are going to have a price that's below cost reflectivity, it's difficult to make the business case for the private sector coming in and developing those generation facilities. So that was a big obstacle. I think municipalities remain a challenge in terms of non-payment, and that does need to be addressed. So overall, those are vulnerabilities, and they're getting consolidated responses, which I think is really good, but it's tricky. I mean, I think the other thing to note is pricing now, right? So, Kenneth already touched on this a little bit, but to say the people who are actually taking up household solar or who are kind of engaging in bilateral deals are currently not paying those fixed costs or those social costs. So whether that's the grid, whether that's subsidies, balancing your technical services, ancillary services, those are system-wide costs that are trying to be recovered through a volume-based tariff. And so now what we have is people who are most able to afford actually opting out of a system. So I think it's really, really important that when we look at market introduction, we also deeply consider vulnerable consumers and how they are affected by this. And it needs to be some kind of hybridized system where we also protect those individuals. So, I mean, in addition, free basic electricity really needs to be reformed. It's been discussed at length, but I think we are not protecting the most vulnerable consumers with this structure. And so that's part of the broader tariff reform to ensure that people don't get shut out. In terms of the sort of green steel and green economy, I think there's significant opportunity, right? And the other panelists also spoke about this when we were instructed to be more positive. But I think in addition to sort of the manufacturing, we're also looking at minerals. I mean, green hydrogen offers an interesting value prospect that's kind of been talked about in terms of an export context. What it could bring in is huge. And we have the kind of potential to really bolster the green economy, but it needs to be thought of in various different components, I think. That's all I'll add. Thanks.
I'm going to close. Oh, Amelia, do you want? I just wanted to have one sentence, well, one paragraph response to Constantine, because I'm going to do an Occam's razor. Isn't really what happened that energy policy became all about Eskom and Eskom was captured? I mean, for a long time, all we did was feed Eskom, and there was nobody stopping that. I mean, that the policy revolved around that dynamic. So, I mean, that if that could happen again, but the great advantage of competitive markets in generation is that becomes a much harder trick to pull off. So that graph of Eskom having the lowest prices and rising slowly. The problem with the Eskom model over that period, as far as I can see, is that as prices rose, so did their operating costs. And not in a disciplined way, and so you didn't get it wasn't like the prices were becoming more cost reflective. Costs were rising as quickly as prices were.
Yes, I think this is really something, yes, that we point this strong correlation between operating cost and prices, so which reflects also the fact that part of these costs are unnecessary, they are passed over to consumer. And here, this is what, I mean, introducing competition in the market is the best way to reduce this cost. You can also introduce some other tariff methodology like revenue cap, because like you fix the revenue, and this also provide important incentive for efficiency. I just wanted to say a few words about, because you mentioned industrial policy. And here we really need to be cautious in terms of industrial policies. This is something also that we touch a bit. I mean, for instance, recently there has been a raise in tariff on solar technology. So this is sold like an industrial policy. This is sold like an industrial policy, but to protect the production chain in South Africa. But our assessment is that it is unlikely that this type of policy become effective at protecting this production chain. And you have to rely on more effective policy involving support to innovation, involving skills. I mean, this is more of a bottleneck to the development of a chain, and not tariff are not the best instrument for that. I really wanted to mention that because I think on industrial policy is important.
I think we're going to call it a day. I don't know where for sure is, but I was told to. Okay. Well, you're up then. Thanks to all the panelists, and again to the OECD for really a very interesting report that I will certainly be using in lots of different places.
So thanks everyone. A special thanks to the panelists. I think we had a lot of fruitful engagement over the two panels and over lunch as well. It was a great day to just sit and talk through many issues. So firstly, thanks to the OECD for a really thorough survey. We enjoyed the process in, coming together with you to discuss the outcomes. And then thanks to ERSA for organizing part of this event, and as well as the Reserve Bank. And the Treasury Comms team. I think we've had a really fruitful engagement, and there's many issues that we have to keep talking about. And a special thanks again to all the panelists. I think we look forward to many future engagements with the OECD as an important partner in sort of our, in our research agenda as well as our policy making agenda. And I think we'll have many more engagements after this. And thanks to Antony for excellent chairing, very pointed questions. So on a last note, if you need parking tickets, please get them from the front desk outside. Thanks, everyone. Have a safe drive home.